By tapering and then raising interest rates, is it possible that the Federal Reserve is intentionally trying to cause a market correction?
What the Fed is doing now is they're with tightening liquidity and all these things, they're waving a pin at the biggest bubble we've ever seen in the stock market.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. When I last interviewed this guest nearly a year ago, he expressed his concern that we were heading for both high inflation and a painful market correction. Well, we sure got the high inflation. So, is the market correction still on his radar? To find out, we welcome back macro analyst Jesse Felder to the program. Jesse, thanks so much for joining us here early in the new year.
Thanks for having me back, Adam.
Oh gosh, it's a pleasure, Jesse. I've really enjoyed reading your work since the last time I interviewed you almost a year ago. So, but let's start at the high level, as I like to do in these interviews, and begin with the question, what is your current assessment of today's global economy and financial markets?
Wow, it's a big one. I think, from the standpoint of the economy, I think we're already starting to slow. I mean, to me, it's kind of a mixed bag. One of the main things I look at was an indicator that I created based on an interview I saw with Stan Druckenmiller a few years ago. And he basically said the best economist he's ever seen is the inside of the stock market. And that is the most economically sensitive sectors of the stock market. You watch their relative performance, and that's probably the best economic indicator you'll find. And so those are things like retailers, transports, materials, industrials, all those things. And the relative performance of those sectors really peaked almost a year ago, spring of 2021. And the relative performance has been weakening since then. Now, they haven't been, when you look at those stocks in those sectors, they haven't been outright, selling off dramatically. Like they're not down 20, 30% or anything. But to me, that the fact that the relative performance has peaked and weakened since then suggests to me that the economic strength that we've seen has essentially peaked and begun to decelerate. And so that to me usually happens, 6 to 9 months before you see a stock market peak. And now that we're seeing the Fed starting to remove liquidity and tighten, financial conditions, that paired with an economic slowing, should, I think, make most investors pretty cautious right now.
Great. So is that sort of another way of saying that you think that the coupling of the economic slowdown plus the tapering, then tightening for the Federal Reserve probably equates to lower equity prices ahead?
Yeah, I think I had an interesting conversation over the summer with Jim Stack from Investec, and Jim just does fantastic work. And he learned a lot through his career from the great Marty Zweig. And he said the two things that are most important to pay attention to are technicals, stock market technicals, and what the Fed is doing. And both of those things began to turn bearish middle to late of last year. I wrote a couple of blog posts about the deteriorating breadth of the stock market. We saw so many Hindenburg omens triggered on the NASDAQ composite index last year. I think it was 12 or 13 Hindenburg omens just on the
Sorry to
NASDAQ.
interrupt you, but can you just explain for folks that don't know what a Hindenburg omen is, what it is?
It's a great question. So, in an uptrend, when markets are strong, you typically see a lot of 52-week highs. A lot of the components in that index are hitting new highs along with the index. What happens when, what's required to trigger a Hindenburg omen is that you have a lot of new 52-week lows at the same time. And that shouldn't happen during a healthy uptrend. And so when you start to see that type of breadth deterioration, the Hindenburg omen was created as a crash indicator, and it's not really effective at that. But when you look back at periods where we've had a number of Hindenburg omens triggered, that's represented a significant warning towards the health of the underlying market, the breadth of the market. And so when you look back at times when we've had those 12 or 13 Hindenburg omens within a 12-month period, it's almost always preceded significant volatility, a 20% plus correction in the stock market. So To me, that was significant technical deterioration we were seeing in the second half of last year. At the same time, the Fed turned hawkish, at least in terms of its rhetoric. I think it's hard to argue the actual Fed actions are hawkish today, but they're certainly talking a lot more hawkish. And that removal of liquidity that they're talking about right now, putting into place, paired with the technical deterioration, to me, tells you that it's time. Yes, it's time for a correction in the stock market is very highly likely. At least a correction, if not, something larger like a, major bear market, which is something I've been looking for a while. So,
yeah. Okay. And that's actually where my next question is going, which is, so you've sort of answered the first question. When we talked a year ago, you said, hey, we may have high inflation and a stock market correction at some point in time. High inflation's here. Sounds like you're saying, and get ready. There very well may be a market correction coming. Given all the things that you look at, what magnitude are you expecting here? You can give a range. I'm not looking for a commitment I'm going to hold you to, but just general sense.
Yeah, no, I think the Fed has to. My friend Julian Brigden has made the point that the Fed has to create a significant correction in the stock market. They have to. When you look at financial conditions, that the Fed monitors, stock prices are one of the major factors in that. And so to appear to the world and to, essentially both political parties right now that they are upholding their mandate of stable prices, they have to tighten financial conditions. And they basically have to catalyze a market correction in order to get that. So, when you look back at what was it that, caused Powell to pivot in late 2018, famously from, we're nowhere near neutral on the Fed funds rate to, okay, we're done hiking rates, basically overnight was a 20% correction in the S&P 500. I think with the inflation today potentially hitting 7% this week on headline CPI or higher, and the Fed funds rate at zero, the Fed's probably never been further behind the curve than they are today. And so the bar, the hurdle for them being able to, for Powell to be able to pivot again is much higher than it was in 2018. So I think, they might need a 30% correction, in the stock market before they can even consider pivoting back to a dovish stance. I think it's fascinating for me to look at. 40% roughly of the NASDAQ stocks today are down 50% off of their highs.
Isn't that crazy?
That's the deterioration that I'm talking about. So it wouldn't be surprising, honestly, with that kind of deterioration under the surface, to see a much bigger correction in the stock market. Now, what would a 50% correction in the S&P 500 look like? To me, it's mind-blowing to think that if the S&P 500 fell 50% from its highs, you still wouldn't even be back to the COVID lows. We still wouldn't even be back to March, the low of March 2020. It now requires a 55% decline in the S&P 500 to get back to test that COVID low again. So to see a 30% decline in the S&P 500, it's just a testament to how much all of this money printing has created. It's created the biggest blow off stock market top that I think we've ever seen in history. You look at the last 3 years returns in the S&P 500, and it's greater than the 3 years ending in March 2000 at the peak of the dot-com mania. So this blow off today is bigger in terms of percentage returns in the last 3 years. It's bigger. Valuations are 30-40% higher than they were if you look at price to sales ratios in the S&P 500. So I just don't think it would be surprising at all to see 30% decline from the recent S&P 500 peak.
Yeah, and as you say, we could lose 30% of the S&P right now, and it would be back to where it was right before COVID hit. And we could have had a discussion back then about how overvalued the market was back then, right? I mean, it's still hugely higher than the peaks of both the dot-com and the 2008 crests. So, all right, so you're basically saying, look, you wouldn't bat an eye if the S&P lost about 30% from here. And I also think your point about, I want to dig just a little bit deeper into your point of the Fed kind of having to engineer almost this market correction. I just looked at Atlanta Fed's GDP now, and it looks like they're saying that GDP growth in Q4 is going to be 6.8%, right? And that's obviously been super juiced by all the stimulus that was shoved into the system over the past year and a half. but it's it's pretty hard not to look at a GDP growth number like that and say, hey, things might be overheating just on GDP growth alone, right? And then, of course, we have the whole inflation side of the story as well, which you and others have just talked to Michael Pinto last week. And he basically said, yeah, the reason why we can't have a Powell pivot this time around is because of inflation. Inflation has just limited the Fed's ability in a way that we really haven't seen in the past decade plus. So I see you nodding here as I'm saying this. So I guess my question for you going on from here is there a particular trigger you think is going to happen here, or is it just, we're at that point where, the Fed is now, basically sort of turning on the asset bubble it helped create?
Well, I think that's probably what's going on, and I think what we've learned over the last 10 years is that central bank policy, this extreme dovish experiment that we've had for 10 plus years, really since the financial crisis, through quantitative easing, the Fed can spur risk appetites, or they can dampen risk appetites. Essentially, this has been the term animal spirits that dates, way back to, the invention of central banking, essentially. That central bankers have always known they can spur animal spirits, or they can dampen those. And I think that the Fed has spurred, animal spirits greater than they've ever done before. I mean, with $5 trillion of money printing in less than 2 years, we've seen animal spirits go absolutely berserk, where you have money just pouring into equities, but not just pouring into equities, money losing in meme stocks and call options, right? I think almost $1 trillion of call options were bought just on Tesla stock last year. $850 billion worth of calls were purchased. It's absolutely mind-boggling. You see it in cryptocurrencies, you see it in everything. So the Fed printed $5 trillion and they kicked risk appetites into a gear that we haven't even seen. I think Charlie Munger said it's beyond anything he witnessed during the dot-com mania. And I absolutely agree that we didn't see risk-taking across all asset classes and these types of craziness that we saw recently. We didn't see that 20 years ago. Now the Fed is saying, okay, wow, we've gone a little too far, and we have inflation, we have asset bubbles. Now we have to rein in inflation, and part of that is going to be dampening animal spirits. The problem that I think the Fed really has is I don't think Powell or anybody at the Fed can play, animal spirits, to the, fine tune them directly to what they want them to be. So I think basically you can create a bubble and you can burst that bubble, but there's not a lot of fine tuning it in between. And so what the Fed is doing now is they're, with tightening liquidity and all these things, they're waving a pin at the biggest bubble we've ever seen in the stock market. And if it pops, there's no putting that genie back in the bottle. It's, you just burst this bubble that you blew up in the first place. And so to me, it's an extremely dangerous game that the Fed is playing. And I think that, you mentioned, it's possible Powell will not be able to pivot again. I think there's no doubt Powell's going to pivot again, because the Fed now understands that the economy is so tied to the stock market. And this is why they've tried to support it so much in recent years, and why he pivoted in 2018. Because if the stock market crashes, you're getting a deeply painful recession. They know that if they spur wealth, the wealth effect is essentially what Bernanke, called it. We're going to try and boost asset prices, create a wealth effect. They understand that the negative wealth effect is probably even more powerful than a positive wealth effect. You see asset prices go up, people feel wealthy, they spend. But if asset prices crash, right, people's spending disappears. The economy goes in the toilet. And so this is why the Fed says we can't allow a stock market crash. And so I think when it comes down to it, they'd rather let inflation run high, above target for, indefinitely than allow asset prices to crash. Now, whether they can have they're able to pull off any of that is, anyone's guess. But I do think they're going to try and tighten financial conditions right now, create a correction. At some point, though, they're going to have to pivot, because they just can't afford to allow markets to really correct to where their natural, equilibrium would be for asset prices.
All right, awesome. I really want to dig into this, because this is the really interesting part here. So, if I understand what you said correctly, and please correct me if I'm stating this wrong, you're saying the Fed is trying to engineer a correction, basically to take enough heat off the system, right, to be able to, you know, get things to a little bit more of a manageable state, but not crater. It's really trying to avoid, it's trying to engineer a correction, but not a crash, right? And you're saying if it begins to get into crash territory, then it's going to have to step in and stimulate, because the negative wealth effects and the maybe vicious cycle that begins, if the system really tries to get back to where, I think if left alone, it would deflate to on its own. That would be perceived as too much, too soon, too intolerable economically and perhaps politically. And then, you know, the Fed would really be doing everything it can to fight that. And there are a lot of people I've talked to who that's basically what they sort of think is going to happen here, which is that we are going to see some sort of market correction event going on here. It may start to get so painful that, you know, the Fed steps in and says, okay, we don't want this level of injury. And then the Fed steps in with a stimulus potentially of a scale that makes what we've seen to date look like child's play. Are you sort of a similar mind to that, or?
Yeah, I mean, we're starting to talk, you know, several steps, you know, in advance, and it's hard to know, you know, 3-4 steps down the road. But I do think that this is what's driven the Fed for, you know, my entire career is, you know, you watch the dot-com bubble burst, and Alan Greenspan's biggest fear was it was a 1929 crash type of precipitating another, you know, Great Depression, which is why he lowered interest rates to 1% and engineered the housing bubble, because he was afraid of another Great Depression resulting from an asset price burst. Same thing, Bernanke was, you know, said we have to do whatever it takes to create another Great Depression when the housing bubble burst. And so the Fed, I think that's the Fed's greatest fear, is that an asset price bubble, when it reverses and crashes, it creates such long-term painful consequences that they have to do everything in their power to prevent that. Now, whether they can, and, you know, I mean, I think really what the Fed has accomplished in the last 10 years is just pulling forward asset returns, you know, from the future. And you can only do that for so long before you know, leave a future of no potential future returns. And I think that's where we are now, is asset prices are to a level where you've sucked out 10, 20 years worth of returns, you know, to the present. And so that leaves a very, you know, bleak view for investors over that time period. But that's also why bonds are priced, you know, less than 2% on the 10-year still, is because that's, you know, kind of, we're in this environment where nothing is priced to really return anything. And so I think that probably what we're facing is, yes, the Fed does need to look as appear as if it's addressing inflation, right? They can no longer say that it's transitory. Both Democrats are now afraid of losing the elections because of inflation, and Republicans are using it as an issue. And so there's bipartisan, you know, pressure on the Fed now. They have to do something, but they're not going to do enough to really. I mean, according to the you know, the Taylor rule, Fed funds rate should be 8% today, 8.5%. Right? I mean, it's insane. There's no way the Fed could go anywhere near the point of actually addressing inflation. They're so far behind the curve. And so to do that would crash asset markets. They're not willing to crash asset markets. So they're going to talk tough. They're going to do enough to create a correction. But at some point, they're going to back off that. And I think, to me, the most interesting implications of that are, you know, can they rescue the stock market? I don't know. But if they do deviate from all the hawkish talk, right now, I think the most interesting thing to think about is the dollar is pricing in 4 rate hikes next year and quantitative tightening. To any extent that the Fed backs off that, they don't actually reduce the balance sheet. Maybe they don't even finish tapering. They don't pull off 4 rate hikes next year. That's going to be a dovish deviation from the hawkish talk, which means bearish dollar, bullish for gold and commodities and all these other things. Because to me, that's already priced in. 4 rate hikes and a tapering, even beyond tapering, you know, we're a rolling off of the balance sheet is now priced into markets. So the extent that they're not able to pull this off, means to me, the most interesting implication of that is gold could potentially really explode the next time we see a dovish, pivot on the part of.
All right, and I want to follow up with you on that, on much of what you just said, but on the gold part specifically, we've had a number of recent guests kind of come to similar conclusions for some of the same reasons, some other ones, but gold just kind of keeps coming up again and again. And folks, I swear I'm not bringing on experts like Jesse because of gold. I didn't even talk about this before the filming started here, but it does just seem to keep coming up again and again through multiple different perspectives, that gold may actually have a really bright future ahead of it itself in the environment that's coming up here. But just to go back to a couple of things you said there, Jesse. First, you're making a great case that I think we make often on this channel, that passive investing, which has been easy for the past decade, is not going to work. It's not going to be as easy going forward. We're entering an environment where there's going to be a lot of cross currents, right? There's going to be potentially markets here that are correcting either because they want to or because the Fed's trying to engineer it, but they might overcorrect and the Fed might step in. So there's just lots of things that are probably going to force the average investor to be more nimble going forward than they've had to be in the past. You also talked about how the way the market's currently priced right now, we pulled so much future prosperity into today that we haven't really left any, going forward. Had John Hussman on the program. We talked both about the Taylor rule, so I was glad you brought that up. But he's got tons of charts, as I'm sure you're familiar with. I'm just going to put one up here, which is his latest future return chart. And it basically shows that the way markets are priced right now, they are indicative that we will have, I think it's something like negative 6% annual returns for the next 12 years, based on the way that that's priced right now, right? So there's just, we've left nothing for future investors in terms of gains over the next decade here. Now, of course, it's probably not going to be negative 6% annualized, for each of the next 12 years. There's probably going to be some massive drawdowns, some years that are recoveries, et cetera. But net, prices are likely going to need to come down, and for all the reasons that you just mentioned here. All right, so I want to follow up on something that you mentioned in your writings relatively recently, Jesse, here. So one of the things that has driven the current financial market prices to the heights they are today, there's all the stimulus we talked about, but there's been a ton of leverage in the system. In fact, I think maybe more leverage than we've ever seen before. You had a great chart of leveraged equity speculation I'm going to put up here. God, I mean, not only does this seem reckless that leveraged assets are at a much higher extreme versus just the general S&P index than they've ever been, but you also note that insiders are selling at the highest annual pace on record. And to me, I look at those two data points and think, is that a sign that the pilots are bailing out of the plane that the rest of the investors are riding in right now?
Yeah, I think so. I mean, you look at the insiders activity, something I've followed for my entire career. I, co-founded a hedge fund, and it was one of the foundations of our research is if you think a stock is cheap, right? I want to see the CFO putting his, validating my view by buying shares in the open market and increasing his own holdings. Conversely, if I think a stock is overvalued, there should be probably some insider selling to confirm that thesis. What we've seen, over the last 12 months is insider selling on a level we've never seen before. And even in terms of the ratio. So I look at the insider sell to buy ratio. Najat Sehoun is a professor of the business at, I think, University of Michigan. He's written a fantastic book on this topic, and he shows that, and this comes back to your original question, when the sell to buy ratio over a 12-month period is elevated, it's a very good predictor of 1 to 2 year returns in the stock market and 1 to 2 year future economic growth. So what we can infer from this massive insider selling is that the fundamentals for the next 1 to 2 years are probably going to be weaker than consensus right now. but also stock market returns are probably going to be weaker than most people expect. That's why you see all the insiders selling. I think it's most interesting to note too that the selling is coming out of these big tech stocks. It's Elon Musk finally deciding to selling a chunk, massive chunk of Tesla. Jeff Bezos finally selling massive chunks of Amazon. Mark Zuckerberg, I think Bloomberg had a piece. Mark Zuckerberg was selling Meta stock every single day last year. So tens of billions of dollars worth of stock. And so you see it in these tech stocks, and I think there's a number of reasons, that they're selling. But the most obvious one is valuations are the highest they've been. My friend Eric Cinnamon recently pointed out price to free cash flow on the 5 biggest stocks in the S&P 500 is 30, 40 times. If you take out stock-based compensation, which adds to cash flow, you're talking 50, 60 times free cash flow these stocks are trading at. So it's by far the highest valuations any of these companies have seen in the last 10 years plus. And what I think a lot of people don't appreciate is the fundamentals of every one of these companies is deteriorating dramatically. They all saw huge revenue growth in 2020 as part of the pandemic. Revenue growth at every one of these companies is dropping dramatically. I'm talking, from 30, 40, 50% year over year to potentially single digits and even negative revenue growth for some of these companies, Google, Apple, notably, this year. So when you have the highest valuations in 10 years paired with rapidly slowing revenue growth, I think that's a recipe for what we're seeing at these companies. Everyone's saying interest rates is going up and that's why these NASDAQ stocks are getting hit. No, you have the highest valuations that these companies have ever seen in terms of free cash flow. At the same time, free cash flow growth, revenue growth, earnings growth are all going to drop dramatically this year. That to me says that valuations have to come down in sympathy. And that's why these insiders are selling. They know we're going to get the best possible prices today. Fundamentals are deteriorating. This is an opportune time to cash out.
All right. So that's a very strong signal that they're sending to the people who are watching, which I think is really important. The service that you've been doing in your writing here, telling people, hey, look, the guys who know the most are getting out, right? Now, these companies in particular, these big tech companies that you listed, I mean, they've really been the lead horses dragging the market outperformance over the past bunch of years. And, you mentioned earlier, they are basically single-handedly supporting the major index prices right now, right? You talked about, 40% of the companies in the NASDAQ are down 50% or more, right? But not like the 5 or 6 big, FANG stocks or whatever the new acronym is now. They're gonna have to come up with a new one where you replace F with M, I guess, because of Meta, right?
Right.
So if those big stocks begin to stumble, then we're really going to start seeing the big indices coming down. One, because they make up such a big percentage of those indices, but also, and I was talking about this the other day with, I think it might have been with Michael Pinto, but they're so over-owned, right? There are so many funds and ETFs that own those companies that you begin this sort of vicious cycle as investors begin to bail out as fund prices are dropping. It forces to meet redemptions. It forces additional sales of these companies. And so, I guess my question to you is there a bigger knock-on effect of these 5 companies going down, given how lopsided this market is right now in terms of how much market value those few companies hold, than we've had at future corrections in the past? Like, does it make the market more vulnerable this time because of that lopsidedness?
Yeah, absolutely. I think, people don't recognize how heavily weighted, because we had this shift in the way they determine sectors in the S&P 500 that, they split out communication services from technology. But if you put those back together again, technology has never been a greater weight in the S&P 500 than it is today. It's, by far the biggest sector. And you're right. There's an important passive dynamic that's gone into inflating these companies. If you go buy almost any ETF, they're the biggest holdings, in the S&P 500 and the NASDAQ 100 and in all of these things. And so when money flows in, and last year we saw inflows into equity funds, for 2021 were equal to, I think, the 19 years combined prior to 2021. So massive inflows into all of these equity funds. The majority of that money, a third of it plus, goes into those massive stocks. And so, are you going to replicate 2021 again and create those kinds of flows again? Very unlikely. But I do think it's really important to recognize that those companies are now the stock market, and I think that was also exacerbated by the trend towards ESG, which we also saw around the same time, 2019, 2020, where a lot of people said, okay, I want to do not just make money in my investments, I want to do good, for the environment and one thing. And essentially what ESG did was say, we're going to just put more money into tech. We're going to take it all out of energy and materials and these things that are potential, mining and whatnot. And we're going to just have an even greater tech weighting. And so people who went into ESG essentially said, yeah, okay, I want those stocks, but I want even more of them instead of, whatever it is, third of, the S&P 500, I want 50% of my account in these top 5 stocks. And so, there's been so much crowding into those things, whether it's wittingly or unwittingly. I think, a lot of people have been buying tech and ARC and these things. But I think there's also this unwitting, crowding into those stocks with people just buying S&P 500 and not realizing that, when you are putting money into those things and flows are going to the S&P 500, it's all concentrating in those bigger names. And, I think there was an interesting, study that pointed out that for every dollar of inflows into these things creates $5 of price appreciation. And so we've seen those massive inflows last year. We haven't really seen, what happens when those flows stop or reverse. And I think that's the biggest worry, because I don't really believe there's anything, there is any such thing as a truly passive investor. Everybody's an active investor, and everybody is forced to time the market at times, just based on their own psychology. This was another point that was made by my friend Jim Stack when I talked to him, is that people don't time the market poorly. People who sell at the bottom, and this is an important thing, I think, to think about now when prices are good. The people who sell in 2009 at the bottom, people who sold in 2003 in the bottom, are usually people who are, have, let's say you had a $2-3 million retirement account, you're blessed. Bear market takes away 50% of that. You say, okay, now I got $1.5 million or $1 million, and I have to live the rest of my days on this. I can't afford to lose another $400,000. I have to sell today to preserve what I have and make sure that I can live out the next, 20 years of my life, and I have enough capital to do that. That is not a timing decision or anything. That is I have to preserve my own wealth at some point. And so I think there are no such thing as passive investors. I think everybody's an active investor. The market forces you to buy or sell at times, and you can choose whether you want to be an intelligently active investor or a non-intelligently active investor. And I think most people do it in a non-intelligent way. But I think that what we're going to find in the next bear market is there is no such thing as a truly passive investor.
Very important point. And Jesse, after we're done here, I'm going to have the lead partners from New Harbor Financial on, who's one of the financial advisors that's endorsed by Wealthion. And I'll just tell them where to send the check, because I think you're basically making a great case for why working, under
I have no affiliation.
No affiliation with them, but you're making the great case for, hey, look, benefiting from the guidance of experienced professionals is probably a good time for that, versus just, set it, forget it, and not being terribly proactive about what might happen to your wealth if some of the stuff we're talking about here actually does come to pass. All right, Jesse. So let's start making this, relevant to investors on a more personal level, which is, okay. So you've definitely flagged a number of concerns that say, okay, maybe I should position myself for the potentiality that there may be some market disruption this year. You mentioned gold earlier. I know you wrote a piece on oil that I want to talk to you about briefly, but given the environment that you see ahead, what asset classes, sectors, specific instruments do you think will fare better, will be more appropriate places to park capital than, say, the general market of the tech stocks like we've just been talking about?
Yeah, well, I sound, probably very bearish compared to, what people see on financial television or whatnot, but I think it would probably surprise people to learn.
Our interview with Jesse continues over in part 2, which will be released tomorrow as soon as we're through editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to click the like button too down there while you're at it. And if Jesse's warning about the probability of both a market correction and a recession has got your attention, then be sure to register for Wealthion's approaching online conference on January 22nd. The focus of the conference will be how investors like you can safely navigate the challenges ahead in 2022. And the speakers we have lined up are just tremendous. Jim Grant, Jim Rickards, Lacey Hunt, Luke Groman, Danielle DiMartino Booth, Rick Rule, Brent Johnson, Tavi Costa from Crescut Capital, that's just to name a few. And they'll be joined by experts on real estate, farmland, precious metals, and the blockchain. You'll want to act now while the early bird price discount of over 40% is still available. To learn more about the event as well as how to register for it, just go to wealthion.com/Jan2022. Okay, I'll see you next over in part 2 of our video interview with Jesse Felder.